Hey everyone, welcome back to another episode of Trading Kaki's weekly series. First up, we have the FOMC minutes. These are not to be confused with the FOMC meetings. These are released 3 weeks after the respective meetings and are a more timely summary of where the market currently sits and what to possibly expect for the next FOMC meeting. So for this current set of FOMC minutes, all participants have favoured a 25 basis points hike in the next FOMC meeting, with some even favouring a 50 basis points hike. The Fed continues to reduce their balance sheet, which means less buying of bonds and thus less money into the market, and the prospect of recession in 2023 is elevated. Next, we have the fourth quarter 2022 GDP, which basically sums up the economic growth for the US for the entire year of 2022. For this particular quarter, it was up less than what the market had forecasted, and this is evident of the dampening effect of inflation on consumer sentiment, with consumer spending rising the least since Q1 2022. On a whole year basis, it was up 9.2% year-on-year, and this was lower than the previous year's year-on-year rise of 10.7%. The core PC index, which strips out food and energy prices, which are actually the more volatile items, is the Fed's preferred inflation gauge as it gives a more accurate measure into the underlying consumer sentiment. This was up higher than what the market had forecasted on a month-on-month basis, and President Joe Biden actually made a comment that this higher than expected rating shows that the country has more work to do. More buyers were stepping in as we see new home sales rising higher than what the market had forecasted. This was actually on the back of recent price drops as well as easing mortgage rates in January. However, for mortgage rates, we have actually noticed a recent tick up, especially in the last few weeks. However, this should be able to be offset by the new supply coming onto the market, especially with the previously delayed construction, which could see further moderation in prices if these two items balance out. With all that said, there's actually a slight relief to the market, with consumer sentiment reported by the University of Michigan coming in higher than the previous month and inflation expectations slightly lower than the previous month. And the 5-year outlook remains unchanged at 2.9%. These are the key macro events next week, pretty light compared to the week after where we will have the non-farm payroll data come out. So for this coming week, it's important to observe, as however the market reacts will give us a good gauge of the sentiment as we go into the following weeks. The market was generally bearish this week as we see the less than positive indicators coming out, and for the SPX, it actually broke out of the 50-day EMA as well as the 200-day EMA. So especially for the 200-day EMA, that was a key support level. Currently it is trading within the downward channel, and the next support level would be the 3890 level. The Dow Jones also broke out of its 200-day EMA and closed at the lower bound of this consolidation channel that we've drawn here, and the next two support levels are at 32.5 and 32. The Nasdaq, on the other hand, closed slightly above its 50-day EMA, however it is still trading in a downward channel. This was mostly weighed down by stocks, particularly Tesla and Apple, which were not able to hold their previous week highs. For small and mid-cap stocks in the Russell 2000, it's currently trending downwards, which is a reverse from what we saw last week. However, it closed above both its 50-day EMA and the 200-day EMA. The volatility index was trading above 20 for most of this week. It has actually bottomed out from the high teen levels that we've seen for most of the start of this year. The next resistance level is the 200-day EMA at 23.5, and if we break above this resistance level, we could possibly see a slide in the markets. We saw some strength in the dollar index as it finally broke out above its 200-day EMA and closed above 105. The strong dollar usually comes hand in hand with aggressive rate hike expectations, as we see more demand for the US dollar as the bond yields would increase alongside with the rate hike expectations. As if the controversy around the spy balloon incident had not died down, China-US tensions continued to be escalated again. This time it was driven by Russia-Ukraine diplomatic controversy, and China's authority had also signaled a new round of crackdown which is targeting the finance industry. Week after week, we've been seeing the same pattern between the short-term yields and the long-term yields. So for this week, the spreads between the 2-year and 30-year have actually widened further this week, and inflationary recession is highly expected. As the Fed continues to reaffirm the message that interest rates will continue to rise, we see cryptos correcting this week. However, both the uptrend for Bitcoin and Ethereum remain intact. The only performing sector this week was energy, as it's usually a direct reflection of the sentiment of inflation concerns. And the losing sectors, on the other hand, are no surprises, which are the real estate, communication services, and consumer discretionary, which are usually the more interest rate sensitive or the more cyclical stocks, which are hammered by more rate hike expectations. The key earnings this week was Walmart, Coinbase, Home Depot, Nvidia, and Alibaba. Despite beating both its revenue and earnings estimates, Walmart was actually down on the week. Being a very consumer-driven stock, these price movements actually dictate investor sentiment on a more forward-looking outlook. So we see higher costs for rental housing and higher costs of food, as well as continued rise in interest rates that could further dampen the outlook for the economy going forward. And with that, margin compression will be a headwind for the company. Coinbase, which is also one of our stock picks last week, was also down on the week, even though it beat both revenue and earnings estimates. This drop in price is seen more of a temporal reaction to the drop in crypto markets this week, and many analysts and investors continue to be optimistic that the crypto markets will rally this year. However, do be cautious that this is highly dependent on the rate hike cycle as well as the state of the monetary cycle. Home Depot missed revenue estimates, and this is actually a clear sign that demand is slowing for home improvement goods this year, especially from the pandemic highs where we see a lot of homeowners going on to Home Depot to redecorate or remodel their house, and this time round they could be more sensitive to the higher prices and more sensitive to the rate hike cycles. Nvidia had tremendous recovery in price this week, as it beating its revenue and earning estimates has actually been seen as a positive light, especially with the bearish sentiment on semiconductor space. Going forward, a new wave of AI research and development will drive the demand for Nvidia's GPUs, so that could be also another positive light. Sentiment, if not for anything else, is very heavily weighed onto BABA. So even though the company expects continued recovery in consumer sentiment and economic activity with the recent reopening in China, the recent crackdowns, as we mentioned earlier, which is geared more towards the finance sector, has weighed down investors' hope of Ant Group's listing this year. These are the upcoming earnings to look forward to next week. So there's the consumer companies Best Buy, Costco, Kroger, and Target. And we also have Zoom, Rivian, and Neo. We have two stock picks for you next week, which are Style Bulk Carriers and Safe Bulkers, which are both in the dry bulk industry. For these dry bulk companies, which are merchant ships or specialized merchant ships used to hold these unpackaged dry bulk material, the main catalyst would of course be the improvement in freight rates as well as more trade routes. So these two catalysts are exactly what we pointed out to be. First would be the Baltic Dry Index bottoming out, especially since the supply chain disruption since the start of COVID-19 has started to taper. So that would mean an end to the falling freight rates, and that would have a direct impact on the top line of these two companies. For Style Bulk Carriers, our entry is at $24 with a 2-week target price of $27. And for Safe Bulkers, our entry price is at $3.50 with a 2-week target price of $4. We'll give a review of our stock picks last week, which are Coinbase and Silvergate Capital. For Coinbase, it actually hit our entry of $62, however it closed lower on the week. For Silvergate, unfortunately, has stopped out at our stop loss price of $15.50. That's all we have for this week. We hope you enjoyed the content, and please remember to like, subscribe, and stay tuned to more of our content on our YouTube page as well as our Instagram page.